Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Welcome to the bigger picture of me, Ryan Huang, and lots to unpack this week. We've got oil prices on the move. We've got the FOMC in action. Will we see a rate cut, or will they push it for a June rate decision? And we've got a preview of earnings from a bunch of banks, as well as a slew of different industries in the U.S. So helping us to navigate what's to come in the next few days, we've got Kelvin Wong. He is the Senior Market Analyst for OANDA. Good morning, Kelvin. How was your weekend?
Not too bad. Has a kind of a restful weekend and also much exciting after the Singapore election. Yeah.
Exciting indeed. And I think the dust is still settling. Folks are digesting the landslide victory by the ruling PAP party. So in terms of market implications or reactions, do you expect any big moves or reactions?
No, because I do not expect any movement in terms of the political factor towards the Singapore stock market. Whereas the market participants in the Singapore stock market will paying more close attention to what happened externally, especially the ongoing trade issue between U.S. and the rest of the world, whether there will be a clear de-escalation between U.S. and China especially, and as well as this coming week outcome of the FOMC meeting, primarily not more on the outcome, but it's more on the guidance that is likely to be portrayed by Fed Chair Powell during the press conference there.
Yeah, talk to us about where we are right now when it comes to trade tensions, because we've been hearing signs about Donald Trump willing to dial back and reaching deals as well. Where are we? What's the latest you're hearing on the front?
Yeah, because if you look at the market charter right now, it seems to us that there is some pricing in of this optimism that China and U.S. potentially is coming towards the negotiation table to actually de-escalate the current heightened tension of that tit-for-tat measures that is being evoked by these two countries in the last 3 weeks. So that explains that 4 weeks of rally seen in the major U.S. stock indices and as well as the rest of the world. But that's from the stock market perspective. But if you were to look at other perspective, like other cross-asset classes performance, I would say that it's not clear sign of a green signal yet that the dust has already settled on the pessimistic side of the thing. Is that there is still some risk involved that this particular trade war 2.0 potentially may start to spill over into a much more negative repercussion into the real economy, especially in the U.S. So if you start to see the U.S. dollar, look at the dollar index, there is still not so much of a clear bullish move in the last 4 weeks versus the movement in the stock market. And as well as, very interestingly, if you start to see the longer-term U.S. Treasury notes and bonds, the prices have started to actually drop in the last 2 weeks or so. So if this continuation of that weakness of the U.S. dollar and weakness of that U.S. Treasury bond prices, that means a spike up in the longer-term U.S. Treasury yield, that could actually create a tightening liquidity condition in the U.S., and this i.e. that, and also putting in line of that U.S. exceptionalism team play that continues to fill out since April. So that may not gel well to the U.S. stock market as a whole if you look into this eager market correlation play according to the different asset classes movement in the last few weeks.
All right, Kelvin, we've been seeing, like you mentioned, a bit of a dialing back of the rhetoric from Donald Trump towards more of a deal-making stance. Is that one reason why OPEC Plus has agreed to increase its production? Because we've been talking about how the global economic backdrop has been uncertain. Some folks are talking about a recession. So how is the market going to absorb even more production of oil in the market?
I found the OPEC Plus darling, so-called potentially increasing its production, apply back to normal. It's a bit puzzling, right? Because if you look at the situation right now, like international third-party bodies from like OECD, then we have the IMF and the World Bank issuing much more dismal or lackluster global growth forecasts in this year and next year, potentially lead to this slowdown in the U.S. economy. And on top of that, do not forget over here is that U.S. is still on the path of cutting down on its civil service workforces. So that actually put a dent on the so-called expansionary U.S. the growth prospect of the U.S. economy. So the supply comeback that actually advocated by OPEC could likely be more political driven, I would say, rather than economically driven. As well as if you look at PMI data from US, is not really that great. And if you look at consumer sentiment in the US, also has been pretty much on the downward trajectory as well. So I found the decision of OPEC Plus to actually increase its supply production back to normalcy at this level is rather puzzling now.
Yeah, we are seeing prices go towards $58 with that 4.6% drop overnight with global benchmark Brent. That is with the latest hike of more than 400,000 barrels a day from June. All right, taking a look at what else is also coming up in the next few days. We've got earnings coming through. We've got the local banks, as well as some car makers, as well as some of the big names like Disney. What's going to be the standout ones for investors to look out for?
I believe that most likely investors will be looking out for companies that are more skewed towards consumers spending, especially Disney itself over here, Disney Plus. So quite discretionary consumer spending, and as well as the local banks as well. So let's start with the US side of the story first. Because if you look at the US side of the story, the last 2 weeks or so, we start to see, I would say that guidance-wise, it's not that great, right, as per se as a whole, because most of the companies that reported has started to state that risk of economic slowdown that may creep or trim profit growth potential due to the potential pessimism that could be inflicted on consumer spending in this ongoing U.S. trade tension with the rest of the world. But on the other hand, if you start to see the mega cap U.S. stock itself, some of them have started to post rather rosy guidance. Example will be Microsoft of increasing its AI investment. So, but however, mega cap companies that produce, we call it a physical product like Apple and Amazon as well, doesn't really have much of rosy guidance. So that actually spoke market a bit. So market participants now will be focusing on the consumer discretionary, we call it stocks earnings. Disney Plus will be one of them.
All right, lots to look out for when it comes to earnings, and helping us to unpack all the details of what to look out for is Kelvin Wong. He is the Senior Market Analyst for OANDA. Kelvin, thanks for the time this morning.
My pleasure, Ryan.
All right, great chatting with you. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.